So thank you. In this presentation, which will be about 25-30 minutes, I'll explain how the things work, how we send out the message, and what you're supposed to do. So if you have attended this before, maybe it's um, repeat, but I always try to add something new. And the table dancer. What time do the table dancers start? I don't know, John. Table dancer. Okay, so let's say we spot Meta on a day chart. So yesterday, I think, yeah, it was yesterday. Yesterday we saw Meta. So things start, for me, the things start from day chart. So this is where the things are happening. So once I spot the pattern or what I'm looking for or what on the day chart, then I lean towards the weekly chart and see if that market is pulling back, then the weekly chart is not there yet. So the weekly chart is it could be also down. So let's say the weekly chart shows some kind of support, and the day chart is showing the pattern what I'm looking for. Some gap, some activity, some support, some kind of a help. So once I spot that, then let's say I decide that I need to take this trade. Then, since I'm trading options, so I have to figure it out the strike. So a lot of things goes on in understanding what strike to take. So I held another session about 2 weeks ago, how I determine the strike. So there are many criteria. It depends on the market, depends on the instrument itself. It depends how many open positions I have. It depends where the support is, where the resistance is, where the target is. So what and other what open interest, the volume for the strike, implied volatility, the days left in the trade, etc. What else I have? So let's say I said okay, Meta is trading, let's say at 129 or something like that. Then because 129, if it's trading at 129, then I have to choose between let's say 125 strike or 130. So since Meta is moving faster, so I say okay, it doesn't. I don't mind going one strike out of the money because 130 is just around the corner. If the Meta was trading at 126 or 127, then I would choose maybe 125. But if I expect that Meta will move faster because the market is looks like market is bottoming out, gave the first signal on Thursday, last Thursday, and other stocks are also moving. So Meta is not the only one. I see Amazon moving, Facebook moving, not the Facebook, Apple, uh, Tesla. So all these big boys moving. And the market is giving out some kind of a bottoming signal. So out of the money is okay. So December 130. So buy 130 calls at 10, let's say. So this is what we send out in the first uh, alert. So just one line. We are not interested in bombarding you with all the theory and the P ratio and the growth and whatnot and what it will do in 5 years. What do you expect where the Meta will be 5 years down the road? All I care is where Meta will be 2 days or 3 days down the road. That's it. Not 5 years from today. I don't know. I don't even know where I will be 5 years. If somebody asks me where you will be after tomorrow, I don't know where I'll be tomorrow. Ask me again where I will be tomorrow. Tomorrow night, I'll tell you where I will be tomorrow. So Meta, just one line in the email and in the subject, Meta December 130 calls, buying to open at 10. That's it. So we send out SMS and email. So what it means is Meta is a symbol, month is the December, strike 130, and we always buy third Friday call expiry unless it is specified. That's where the volume is. Others are weekly or quarterly. So we don't trade quarterly or we don't trade weekly. So I do know that choose. So if I'm trading, I tend to remember where is the third Friday. So select that third Friday strike 130. And then also when we are selecting options, see if the spread is normal, see if this volume is there, see if there's an activity going on. So if you stare at that option chain, the strike, you will see there is life in that strike. So you would know there is a life in that strike. Like you're not the only one. Click and that's it. And 10 minutes later, it clicks again. So you can see there is a volume going on. People are buying or selling. So strike 130 calls. Action is buying to open. So buying to open. Suggested price $10 and third Friday expiry option. So once we send this, we prepare chart. Sometimes we forget to send the chart to our members. So I prepare the chart or I ask someone in my company to prepare for me and we send out. So we send out the chart, some explanation, so technical and some kind of explanation. Then before we enter any trade, we need to know where we will exit, whether at loss or at profit. There was a movie I saw a long time ago. So these movies, uh, they tell you so they tell you something. So always try to relate. So in this movie, I forgot the name of the movie. Robert De Niro and his gang. The movie is set in some European country. So he is about to enter in the building, but he tells to meet some another guy from the other side, another bad guy. So these are Robert De Niro and his gang. They are also bad, but they are meeting another bad guy. So Robert De Niro tells his guys to wait. Um, uh, Before he goes inside, they need before they go inside, they need to wait. So he goes and come back after 10 minutes. So his buddies asked, where did you go? So he said, I went to the back of the building to figure it out. When I'm coming out of this building, from which window I'll be jumping out. So that's the way it is when you are coming out of the trade, where you will be jumping out, uh, whether at profit or at loss. So these target needs to be determined, whether there is a potential, whether it's the stock you're buying is not buying at the top, or you're not buying at the overbought zone, etc., or there is not an immediate resistance there. So I pay attention to the resistance levels immediately. If there is a resistance, heavy resistance nearby, doesn't matter how great that stock is looking at that moment, that resistance is like brick wall. It will stop, not today, tomorrow, and then I'll be left holding the bag. So I calculate. So I have a way of calculating the distance from the entry price to the first resistance level. So I calculate the distance and then I take ratios. So I take ratios, I determine all the resistance levels, and then I take the ratios from the current price and figure it out if there is some meaningful distance from the current price to the first target. So I call it green target, and then the second target is the yellow, and the third is called red. So resistance is not just one price. So resistance is a zone or is a channel. And the same for support. Support is not just one price, it's a channel. There's a lot of actions happen in not in just one price, like 100. So things happen at 99.01, 99.02, or 100.50, 100.51. So it's a channel. So figure it out that channel for support and for resistance. So the targets are based on major turning points in the past. It's easy to determine the targets um, if that stock has or any instrument has traded before. So it's easy. But if you are traveling in an uncharted territory, like sometimes the stock is making a 52-week high, and then I send out the target, and then I receive email, hey, how did you figure out this? to the penny, the new target. This target has never been there. So there are methods to estimate the targets in the future, um, where the stock has never gone there. But most of the stocks we are trading, uh, they are trading in the previous zone. So they have been there. So if you're trading Meta, you can see on the chart where are the turning points. And the turning points are easily detected on intraday level charts, so hourly chart, 2 hour chart, etc. You can see the turning points um, on intraday level. But anyway, on a day chart also. So the targets are determined based on the resistance level for the calls. For the puts, targets are determined based on the support. Now, that's one thing. So that's the where I will be exiting with the profit. Now, when I'll be jumping out of the window, where how how far I will be, and how low is the that place where I will be exiting. So that support level should be closer somewhere. The support level should be closer somewhere, not far. So I can calculate, let's say I calculate from the current price the support level, and I get that price. Now, and then I also calculate the current price from and the resistance distance. So current price and the resistance difference, and the current price and the support distance. So the current price and support distance should be less than the current price from the resistance. So that is called risk and reward. So I am showing the uh, yeah, there is only one slide. I'm showing the trade targets. I'm explaining the targets. Sorry, I'm just explaining the targets, how I determine the targets. It's all theoretical. I'm speaking. Sometimes I do show the chart. So in the previous presentation, like yesterday, I think, yeah, I did show the chart. So, so, so what I was saying, that the stock entry price and the support, you take the ratio, the distance, and the current price and the resistance, you take that ratio. So if you're going on long, the ratio, if you take that distance from current price to the resistance and take the ratio from current price to the support, it should be 2-3 times. So in other words, if the stock is trading at 100 and the support is at 98, so that's $2 away, and then the resistance is at 6. So from 100 to 106 is 6. So 6 divided by 2 is 3. So that is your risk to reward. That you're risking $2, and the target is 6, 6 point. So, and then what would be the probability? So you assign the probability of whether the stock will go and hit uh, your target of 106, or it will go to 98. And what you will do when it goes to 98? So all that goes on. So we send out the targets, 3 targets. So we call it green, yellow, and red, or first target, second target, and the third target. So green, yellow, and red. And then there is another target called beyond red target. So beyond red target is another way of saying revising the red target. So types of target, green, yellow, and red, and then beyond red is revising. So sometimes we revise. Like for instance, we revise, so we trade ETFs. So in the ETFs, options like DIA, SPY, IWM, QQQ, LABDL, OH, USO, etc., all these ETFs, as a semiconductor ETF, financial ETF, gold, silver, and then the indices. So we revise the Dow Jones target to the upside. So I believe the Dow Jones is going higher, much higher. So the second target hit to the yellow target, but we revise it to the upside. So, so we do have ETF options trading. It's on the website, 87 per month. So we send out green, yellow, and red target for you, types of targets. So now let me explain what is green, yellow, and red. So it's like traffic signal. So green means go in the traffic signal. Yellow means you just pause or keep going. You know, just keep going if you know you can cross. So sometimes you just keep going and you don't hit the red light. And the red target means you just stop, like a red signal. You need to stop. So that's the relation. So the green target. So the when you are estimating the target, it's easy to estimate the target um, when it's close by. So if the stock is trading at 100, it's easy to estimate. Okay, it will go to 103 because there is a momentum there. The market is moving, and I can safely bet uh, that it will hit 103. So that is a green target. But when it hits 103, what will be my gain? So at 3% move, if I enter at 100 and 103 is the target, then at 3% move, I will gain 25-30% options gain. So I do calculate. So when the target is hitting, I get the alert, and then I also get the alert for my options. So what options I'm trading and how much gain I have. So I calculate um, the ask. I take the distance between the ask and the bid. So in between the mid price, and I also check the last price. So I compare the last price and the mid price and see what gains I have when the green target is hitting. So I get the alert on my system, and then we send out the alert that the green target is hitting 25% or 30% gain, or sometimes the green target is far, so it could be 40% gain. And sometimes we revise the target, green target, if we see, oh, green target just hit so fast, or it took so long to even hit the green target. So we may be closing at green target. So it depends how fast the target hit, and what kind of gains we have. So we adjust also. So constantly evaluating for calls position. I'm constantly evaluating the resistance every day. So there's a process called debriefing. So debriefing process uh, is you can do at the end of the day, like 15 minutes before market close, you go through your open position, you go through your open, the position you open, you go through the position you close, you go through the market. So it's like debriefing, 15 minutes of debriefing. You can start at 12:45, or if you don't have time, you do it in the evening. So I do the debriefing during the day with my team. So I'm constantly getting the feedback about the position. So based on the automation, based on the other things, I'm constantly reviewing the support and resistance, because support and resistance can be created. Uh, there is a support and resistance which you analyze when you enter in the trade. But then there are dynamics. So the support and resistance are getting created during the day. Every day there is something getting created. How meaningful it is, we need to know that. And sometimes the resistance is meaningful. Sometimes it just not doesn't have that much meaning. So constantly evaluate support and resistance during the day, at least once a day. So maybe you intraday, if you see some reaction in the stock, or after the market is closed during your debriefing, you go through your open position and do the open support and resistance analysis. So when, let's say, when the stock is hitting a green target, I not only get the alert for the green target thing, I set the alert for the option, but then I also evaluate the resistance level right away. So I say, okay, the green target is hitting, and the resistance for this analyze is documented. So I know at the time I open the trade, we noted down this is the resistance. Now, what is the resistance right now when the green target is hitting? Is there any resistance created intraday? Because sometimes the stock is moving up and down, up and down, up and down, and then suddenly, boom, it hits the target and get the alert. But that up and down, maybe it created some resistance. So analyze that resistance intraday and figure it out what impact it will have on your position. Maybe you need to exit from this trade completely, or there is no resistance. So whatever it is, so you do that. So the green target, when the green target hits, even before the green target hit, the system tells us that the green target is approaching. So you can set, we provide you the green target, you can set 50 cents, 60 cents alert that the green target is approaching, or this target is approaching 50 cents before. So not exactly at the green target you set. So, by the time it hits and you miss it, uh, it can have some negative effect. So you're just trying to eliminate some mistakes. So set the 50 cents before, so you get the alert, and now you're at the like uh, exit protocol triggered for the green target. That's what it means. Before, if you set the 50 cents before, depending on what the stock price is. For a stock which is trading at 500 price, then maybe you'll set the alert two, three, $4 before the target is reached. But if the stock is trading at 10, $12, maybe 20 cents is enough. So exit protocol triggered for green target. So at that time, analyze how long you have been opening a position, what kind of gain you have, whether you average down. So if you average it down, you bought Meta at 10 and then you pull back to support and then you bought more. So your cost is $8 and now the green target is hitting. So you have more gains. So instead of 25%, maybe you have 35, 40% gains in that position because you average down. So the green target become more meaningful to you. Or maybe the green target is hitting, but your position is at break even because time decay. Or maybe the green target hit and the position is still losing. So when this happens, I see it and I go and fix the target. I said, no, green target and we are losing in this. So let's revise the target. So yellow target goes into green if there is a potential, not just for the sake of revising the target. If we see that, okay, we need to revise the target from yellow, the yellow become green and the red become yellow, and then there is a new red target. So we do that. We have a various kinds of sell signals. So we have a matrix where we analyze what kind of a sell signal we need to send. So we send out the sell signal that sell, let's say sell some. So if you have 8 contracts, you will sell 2. So sell 1/3 or sell 1/4, etc. So I'll explain all the sell targets at the end. Now the so the green target, the green target has a high probability of hitting, but it doesn't mean that you sell all your position at green, because in the green target, when it hits, you may be gaining 25, 30%. So then you say, no, I'm fine with it. You can go broke taking profit. You can go broke taking small profits. So um, so just be careful. You can go broke taking small profit. So it's out of context where you can go broke taking profits. So small profits, you will go broke. So just be careful what how you're managing it. So now the yellow target is the second target after the green target. So this is kind of in between target. So the yellow target I um, calculate based on some kind of a resistance. So I see that resistance. So just before the resistance, I place it lower. So you need to give some leeway, some offset, some deviation, some percentage of ATR. How much the stock moves in a day, over the last 14-day period or whatever 10-day period you are analyzing your ATR, and then you take some percentage of that ATR and you say, okay, the stock moved $4 on a given day. So 25% of ATR is so it's ATR is $4. So 25% of ATR is $1. So I will, and the target is 100. So I will, the resistance is 100. So 100 minus 1 is 99. So I'll set the target at $99 or something, 98.90 or 99.10, something like that. Not just pure 100, because 100 is a very big number. You may not see 100. You may see like, oh, gee, I said the target. You told me it's going to 100. So I said the target 99.99, and I'm still sitting. And you're saying you're out. How come you're out and I'm sitting? I said the target based on your 100 and 99.99. So maybe, yeah, I said 100, but I just rounded it. I didn't give you the exact number. So, you have to set it, and then maybe 99.99 hit. That was the ask price, but since you're selling, so maybe the bid was 99.40. So, set the target to sell at 99.40. So, second target after the green target is called yellow target. So, because it is further from the entry price. So the probability is a little less, 85%. So just assign some probability that what is the probability that the stock will hit this target. And because it's getting set based on, if its call is based on the resistance. So if you think that's the resistance and you have accurately figured it out, uh, so the stock is supposed to pull back, because the resistance means the resistance means the other name for the resistance is that the sellers are sitting there. So the another name for support is the buyers are sitting there. So somebody is interested in selling, and sometimes the selling is vicious. So that's the meaning of resistance. So if you know the 100 is the resistance, so then you expect a pullback. Now the pullback could be minor, and then the minor pullback can become a major pullback, and then it can become a crash. So the crash comes, it just doesn't happen. It's just a minor pullback, then a major pullback, then the correction happening. Is it a correction? People start asking, is it a correction or is it a crash or is it a recession? Are we there yet or no? Recession coming? Yes, no, yes. So the yellow target hit and now it's pulling back and you did not take the profit. So sell some position or majority of it or half. So we do send out the alert, sell majority or sell um, half. So it depends what kind of a resistance is yellow resistance target. If the resistance is heavy, then we send out the alert to sell majority or sell off. If the resistance is like a middle, then sell half. So not only you analyze the resistance, but analyze the intensity of the resistance, or not only analyze the support, but analyze the intensity of the support. So what is how many times this resistance was hit, or how recent it is, and what kind of volume is there. So recency effect, the volume effect, the time effect. So there are three ingredients of support and resistance. So analyze that, and then decide how much you want to sell. So we do that. We are analyzing constantly, and triggering the sell alert for you in a real time basis via email and SMS. So, and then after we send the alert, let's say sell majority. So after we send the alert to sell majority, and then the 3 days have gone by and the stock is not moving, it's just stuck there. So then we need to sell the rest. Because 3 days gone by, we have sold the majority. So if we have sold the majority, let's say we bought at 10 and sold the majority at 14, 3 days gone by and it's not trading above that yellow target. So options are trading at 13 now. They are not trading at 14. In order to go back to 14, the highest price, the stock has to move another dollar 50, then it goes above $2, $3. Then we will have maybe options trading at 15. So if that scenario happens, the alert triggers to sell rest. Another criteria for sell rest is we know, okay, we have been holding it for these many days and we need to close, or there's a new position coming in. So let's say we bought calls in XOM and we sold majority and we are holding rest. And now we see Occidental, OXY, or Valero moving, and it has more room in the trade. Why? We see that from the current price to the resistance level. So calculate the distance from the current price to the resistance level. So it has more room. Whereas XOM is just topping out. It has done its it has done its move. So what's the point of keeping the rest? Sold majority, keeping the rest. What's the point? I rather sell the rest and initiate another position in the oil stock. So sometimes you see what happened in the oil or financial, that one stock moves and then another one moves and another one, third, fourth, fifth. Everybody starts moving and gapping up. But there's always one which gives you some kind of a clue. If you get the clue in one stock, others are coming. Then others come in a bunch. So for instance, WFC, Wells Fargo came into radar 2, 3 days ago. So we bought calls, and then today the Bank of America is moving, the Goldman Sachs is moving, JP Morgan. So all these are moving. So if you're done with Wells Fargo, then see where is money left. So today I was looking at, I said, oh, Goldman Sachs, it went up so much. Oh, let me see Bank of America. Oh my God, it gapped up 3, 4 times. It's a big bar. So I'm going to, if I buy calls, I'm going to buy at the top, right at the resistance. So I cannot. So I'm holding WFC. So I said, okay, it's better to hold WFC and keep it. So when you have a winner, you try to keep it as long as you can. So if the stock hesitates to move, sell rest. So we send the alert to sell rest. Now the red target. So red target is at some major resistance, not at only the major resistance, but the turning point where the market has turned before, or the overbought levels will be reached. So some like a brick wall. So it has a very high probability that when the red target hits, the stock will pull back severely. So 70% probability, and the probability of reaching the red target is lower because it's further. So it's like if I'm traveling from San Diego to Seattle, this is the example I gave. If I'm traveling from San Diego to Seattle, the GPS will say 24 hours, but I will end up reaching there in 72 hours because I will stop, for lunch, dinner, this, that, exits, gas, and wrong turn. So the same way the stock does. They go hit the targets, but they take many detours. So that's why the probability is low. Sometimes they just don't go. Sometimes I may not go to Seattle. I may turn around from San Francisco and then come back to San Diego. So it has happened many times. So it's the same way the stock does. They say, no, I'm not going there. I'm just coming back down. So you have to recognize it. So 70% probability, 95% probability of a stock missing by few cents. So red target is since red target is a major target and it has a resistance level. So I may have calculated. So uh, there is a so resistance and support. There is an art and science. So I may calculate the distance. Let's say I say, okay, I'm getting in at 90 and 100 is the resistance. So I set my red target at 99.10. And then what happened? The stock went to 98.40, and that's it. So 98.40, I set the target 99.1, and now it's not going up. It's now I see it at 97. So we may miss by a few cents, so be careful. So when I'm sending, before I used to send like accurate. I try to show off and to the penny. I'm sending the target to the penny, and then I sometimes I get the email. How come you calculated the target to the penny? So then overall, so I'm feeling good. I received this. Aha, see, I calculated the target to the penny. And then when I miss it, then I say, oh my God, I shouldn't be show off that I send the exact to the penny. I need to cut it down, relax. So because I saw many times the red target missed by a few cents, and then I'm regretting. So when you see the red target, it's like the train has reached the station. So you don't just, then the train is slowing down. Sometimes the train just keeps going, right? When these targets are magical, these support and resistance levels are magical. So magical means that some acceleration is happening there. So if you see, no matter what you see, it's like tie yourself to the siren. You hear the siren and you need to tie yourself to the mast because on the island are some beautiful girls. So it's like that. No, 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 no. I'm not going to change my sell order. So that's where it will happen. The overshoot happens, and then the market pulls back, and then it's just sitting there. So you don't want to end up in the island. So whatever is your sell order, you have already determined. Just don't cancel it. Let it hit, because when the major targets are hitting, the stock or any market accelerates fast. It looks like as if it's going to break, and then it subsides. So the sell order comes in. Maybe the big boys they get us like that. They accelerate on one hand and they sell on the other hand. So big boys have all the tricks. They are selling in the front, and they're buying in the front, and their minions are selling in the back, or they are selling in the front, their minions are buying at the back. So they're doing all kinds of tricks. So the stock missing by few cents, pulling significantly because the major target, and the run up is over. So sell rest alert is sent, or sell all alert is sent, or sell majority is sent. So all kinds of alerts are sent, and it depends how many days it took for the red target to hit. So all that is taken into consideration. Now, because the red target is calculated based on the major resistance, so something can happen at major resistance. So the resistance are conquered. They get conquered. So when they get conquered, we need to recognize. So one way of getting conquered is uh, the gap up. So I show you. So when the red target is uh, getting revised, there are many reasons for the red target to be revised. So let's say in the pre-market, the market is way, way up. Everything is moving up. Everything is moving up. And this is stock. So what we do, we analyze our position during pre-market hours. So I come to office at 5:30 and I go through all the open positions I have. So all the targets we have, and compare with where the prices are, uh, the, are. So compare all, and then we see, okay, this one will gap up, this one will gap down, this one is doing nothing, is dead, there is nothing going on. What's the volume? So we tend to we send out the pre-market alerts, and if we have to revise the target, we revise the target, especially if there is a gap up or gap down. So uh, the resistance are conquered, either there is a cannonball fired. So if you have a long position, so there should be a lot of buying at the resistance level. So you should see a big white candle breaking the resistance, or crossing the resistance level in a meaningful way, or simply the stock just gaps up above. So if the resistance is 100 and yesterday it closed at 98, today the stock gaps up and sitting at 102. So now, right at the open, it is 102. So there's a 4 point gap. So now you have a. So now you need to analyze the stock. The where is the low, where is the high, where is the low, where is the high. So eventually the stock makes the day low. So the stock makes the day low. So that could be your benchmark. That if it violates today, I will be out, and I know my red target was 100. So it's trading on the other side. It's like river, and you got the magic carpet, and you just suddenly, when the dog is chasing, you set on the magic carpet, and then you cross the river, and now you are on the other side of the uh, river. Get no video back. We will send you the recording. So we will send you the recording, not the presentation, just the recording. So the magic carpet, you go on the other side of the magic carpet of the river. So that's the way the red target works. So when it's happening, we do send you the alert right away that the red target is being revised. Please hold to capture more gains. So we just looking for the way for you to maximize the gains. So stock gaps above the red target, we tell you to hold. It stays above the red, safe to hold. Breaks below red. When it breaks below the red after gapping up, then it means the gap up is not that meaningful, and we need to close. So if the stock gaps to 102 and then it pulls back to 99.50, then we don't know where it will stop. It will just keep going down. So we exit immediately. Sometimes the sell-off is immediate. The stock gaps up and no buying. So the market maker just opened the stock at the high price, and then there is no buying. So when there's no buying, the stock pulling back, so we need to sell. We are at disadvantage because the market, you see the market, option market open at, is at the mercy of the market maker. So he opened the option when he see his book is all taken care of. Then otherwise he You notice that the spread between the ask and the bid is wide, and you're trying to buy the option during the first 10 minutes, and then you say, holy cow, I can't buy this. The spread is so big, large. But if you ignore it, so there, if there is a spread, then you, if there's a large spread, then you are on the right track. You got something. It's just that you don't ignore it. So you spot something at the open, and the spread is wide for the option, so you cannot buy option right away. If you think it's very important for you, maybe if you have money, you can just buy 100 shares of that stock and buy the option when the options open. So if you keep an eye on the option spread, it will subside. It will become normal. So maybe it's too late by then, or maybe it's not. So the option maker, the market maker for the option, he is looking after himself. So he spreads, he makes the spread wider. So you cannot, if you buy, you're buying at the very high price. So it's bid is 7 and ask is at 10. So if you want to sell, sell at 7. If you want to buy, you buy at 10. Later, bid remains 7 and the ask comes down to 750 or 740. So then you decide. So keep an eye on that. Sometimes we send out the message for target revise. So targets, sometimes the targets are adjusted to the downside. So fine tune the target as the trade is progressing. So when the trade is progressing, we are fine tuning the target and adjusting it. So when we adjust, we send you the alert. And the emails or the SMS show the green arrow or the red arrow. So when we adjust to the upside, it shows the green arrow. When it adjusts to the downside, it shows the red arrow. And it also shows you the check mark, whether the green target has hit, yellow target has hit. And we also track how many times on our side, we also track how many times the green target hit, how many times the yellow target hit. If it's hitting multiple times, yellow target is hit 3 times in last 3 days and it's just not going above. So it means it created a resistance. So we tend to sell that position. If the yellow target was 100 and it hit today and came down to 99, then tomorrow it again hit 100 and went to 150 cents. So we count that, and then the next day it pulled back to 99 and then it hit again 100 and then it's sitting at 100.10. So that's the third count. So then we say, okay, this is the third time and it's not hitting the red, so we sell. So we just sell. So we do all kinds of calculation. So second target price is when we revise the target from third to second and second to first, and a new third price is given. Target may get adjusted to downside also. Sometimes the resistance is created. So when the resistance is created at a certain price point, then we lower the price target. So we just, um, we just lower. So the trader make mistake. They go from the profit objective, the dollar objective. Let's say I want to make 40%. When I make 40%, I get out. So if your system generates the trades and give you 40% on average, maybe that's the right strategy. But if your system is giving you trade with it goes to 100% gains in options or goes to 20%, and then you have to figure it out. You're doing something wrong. Some trades giving you 20, some giving you 100. So what is the reason why one has 100 and one has 20? Analyze that trade and figure out the reason. Maybe you collect the data and say, overall, I get out at 40% but my trade keeps going and it's 60%, and then it pulls back. So maybe then you say, okay, the 60% is the it goes to maximum 60. So I need to increase my target to 55% or 57% because I see that it goes to 40%. I get out at 40, but the trade goes after 2-3 days, it goes to 60% gain. So you shouldn't be getting out at 60%, 40%. You should be getting out at 57, 58, or 60% gains. So, but the targets are also adjusted to the downside. So the successful traders are the traders who trade not one market, they trade multiple markets, they trade multiple contracts, multiple units of shares, they have multiple exits. Their entry could be simple, just simple entry, but their exits are complicated. So you can make complicated exits, and exits have many reasons, thousands of reasons for selling, and there could be only one reason to buy. It looks interesting and you bought it, but then you sell for many other reasons. So there could be many reasons people are selling, but there's only one reason people are buying. They see it interesting. So we have these kinds of alerts: selling one third, selling half, selling majority, selling rest, selling all. So selling one third is usually on the green target, selling half is usually on the yellow target, selling majority is mostly on the red target. Selling rest triggers when we have sold, let's say it's half or majority or even one third, but the stock is stuck in the narrow zone, or selling all. So selling all when we have not done any selling, then selling all. Sometimes we give you sell price range. So when the stock is moving so fast, we cannot calculate the option. We don't even know where the momentum will stop. So we calculate the range and give you the range for the stock. We give you the range for the option also. Sometimes the stock is just moving. Let's say you find the stock which is moving, but you have decided that you will exit, but right, not now. Today you will exit. So sell to close by market. So you can set the alert on your broker's platform to close your position by market close. So just 15 seconds, 30 seconds before the market close, your position will be liquidated. So these kind of sell alerts. So pre-market is very important that you analyze your open position in the pre-market and after market. Just spend 5-10 minutes and see. First of all, don't come to the market right when the market is opening. Don't come to that time, you're just paralyzed. Come little early, open your shop, calm down, cool, drink coffee, meditate, do whatever, and just ready to go. Sometimes you're just looking at the clock and you're wondering, oh my God, it's 6:27, now it's 6:28. So in my office, I broadcast to my team. So I have a team members who are monitoring. So I broadcast, the market 6:15, 6:20, 6:25, 6:27, calm down, calm. So there's nobody talking. So I have some assistant who help me. So we all know that 6:30, we need to, horses are just starts running. Which one is running? There's so many horses running here, there. So you have to have a control on them. So analyze your open position in the pre-market. Red target is hitting in a non-regular session. Sometimes there's a news like earning news or some news, and the red target is hitting in the pre-market hour. So it's very important to know that the red target has hit in the pre-market, because that's it. By the time when the market opens, you will not see the red target. Some event occurred, chances are stock will pull back during regular session. So in the pre-market or after market, if the red target is hit, like let's say the gap up occurred, there is an earning came and the stock has just gapped up and it hit the target. So note down the red target, and during the market hours, uh, the stock should be trading above the pre-market high or after market high and continue to the upside if it's a call. Pre-market alert and strategy is sent to members. So when the market is really bullish, etc., a lot of stocks are gapping up and hitting the target. We are very busy in, so it depends on the market condition. So we are very busy in sending the alert during the pre-market hours. What you should be doing. When the market is calm and nothing is happening, then there is no pre-market alert. So it depends on the market condition. So what to do to maximize gain? Adding to the existing position is a good strategy. People say never, 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 ever, ever average down a losing position. So that's not, first of all, don't ever say ever or never. So that's not right. You can add to the existing losing position if you can clearly identify that as an entry point. So you have some criteria of analyzing that I need to add. Sometimes you average up also. So just don't think of averaging it down, but averaging up. Averaging up, and the position is good, you can average up also. Buy some more, buy some more. So you bought 100 shares, maybe second time on the way up, you can buy 50 more shares. Then the third time, maybe you can buy 25 shares. And then the last time, maybe you can buy 10 shares. So you can do average up also. If the position is looking good and it's hitting the target and you want to sell that and you think, okay, it will move up, you can create a spread because it's moving up. You can sell the out of the money call. You can buy a new strike. You can buy a new month. So you need to think of all that, what you can do when the position is really moving and you are in great gains and you don't want to liquidate that position. Maybe the time is running out on your existing position, but you need to open a new position. So don't open the new position when the time is running out in the current month. Open the new position in the next month and a new strike, which is a higher strike in if it's a call position. So do all that. We do send out updates from time to time, what is going on with the trade. So we do that. And also buy more of the same. So when the stock hits some, let's say we are in the call and the stock hits some support and it's bouncing back and the option value has gone down from 10 to 6. So if we see that it's right to add more, then we send out the alert to sell, buy more. So buy more message comes at the suggested price. So when you're buying more, try to buy the same dollar amount which you have bought before. So if you put $2,000 previously, then you ideally you should put another 2,000. What people do is they buy the same number of contracts. So if they bought four before at 10, when they're buying at 5 or 6, they are still buying 4 or 5. So that's not the right strategy. The strategy is to buy equal number of dollars. So whatever that dollar amount, you tend to buy the contract for that dollar amount. So we do send out buying more. And so buying more is only done when you have convinced yourself that the stock is rebounding from support or from resistance for puts. There is another, so we send out the alerts on the stock, not on the options, because it's hard to calculate the option price. There are methods to calculate by plugging in all the numbers in the calculators available on brokers platform or online based on Black-Scholes model. So you have to plug in all the numbers such as the strike, the target, time remaining, etc. And that Black-Scholes model, the basis of the option price, it will tell you estimated price of that option will be after these many days. So that price could be the ask price. So then you need to calculate what is the spread. So if the spread is 40, so then minus the 40 cent spread, and you can put the sell order for that option at that calculated bid price. You may get hit and you may miss it by 5 cents. So options, you need to calculate your targets for based on the options on a daily basis. Another way of, because we are trading a stock, so we are reading the charts of the stocks. So since we are reading the chart of the stock, so we are calculating the support and resistance based and the target based on the stock, not based on the option. So you can set the sell order based on the stock charts, the targets. So it's called conditional order. So you can set the conditional order. I teach in a separate session how you can set it. So you set the conditional order saying that, okay, I want to sell my contract when the target hit 100 or the stock hit 99.10, sell all my option contract. So your brokerage platform have that feature. So ask them conditional order, activation rule, some kind of something like that, activation rule, conditional order, and similarly for the puts. So I want to sell my puts when the stock is trading 100 or below 100. So your order turns from sitting there at the broker, it turns into a market order and you get taken out. So be careful when you are setting the conditional order. It needs to be for the liquid stock, liquid option, because they may sell at the last price and you may not like the last price. If the options are not liquid, and when the conditional order hit, your order becomes the market order. And when the market order becomes the market order, the broker will sell at the last price, or the market maker, whoever, just takes your option at the last price because he has to sell because you told him to make it a market order. So if the last price was something weird, then you are out. So that's the drawback of conditional order. So set the conditional order for the liquid option where the spread is normal and very liquid. So that's for conditional order, and I'll teach the syntax in other session. So that's it for today. And if you have any question, please send me email. 50% is less, 60%, 65%, and it depends on the option price. If you bought option for dollar, then you can lose all 100%. Even a $2 option, you can lose all 100% because minor move on the option as in the stock, the option value is goes down. Or if there is a time delay in hitting the target, your options value go down. So options are meant for hedging and for speculative purposes. So there are two two reasons for option trading: for speculation and for hedging. So options should be traded in a smaller size account. Your main account, the bigger account, should be less risky trades in those big accounts, and you're aiming for 10, 12, 15% gain. Maybe you can aim for 25, 30, so you need to have a strategy. And for option account, you can aim for 1000%. So option is a speculative account. It should have a smaller dollars. The other account should have a bigger size. But when you calculate the bigger size account and the option account, the dollar gain should come out to be maybe more in a bigger account. So because of the size of the account. So size of the account is like a China wall. You can hit in order for the China wall to break, you really need to fire big cannonballs. The tennis ball will not break it. Whereas a smaller size account, you hit it's like a thin ball made of sand. So you hit the tennis ball and it will break. So smaller size accounts are like a very thin wall. Bigger size accounts are like big China wall. You throw uh, whatever, it will absorb. So that's the difference. All right. So I'll see you some other time. And thank you for coming. See you. Bye.